This is an overview of the course, cost management, and the key concepts introduced in this course. We begin with the area of cost behavior. We look at, first of all, fixed costs. Now, a fixed cost is a cost that remains in total constant within a relevant range. But when you look at it on a per unit basis, it will decline with volume. An example being rent. Next, you contrast that with variable costs. Now, a variable cost changes in total in direct proportion to changes in the level of activity. But on a per unit basis, it remains the same. There's also what is called a mixed cost. That is partly fixed and partly variable. And we must break out the fixed and variable part. We use the high-low method. You should also be aware of the concept relevant range. That is, these costs will behave as we predict within a certain level of activity. If we go outside of that range of activity, then those assumptions do not hold. Now that we talked about cost behavior, we'll now talk about cost assignment. To begin with, cost object. We must be familiar with this. A cost object is any item that we want to collect the cost or measure the cost for. A customer, a process, a project, what have you. Also, the concept cost pool. What we mean by that is we group all these costs that sort of have some similarity. For example, we might electricity costs with lighting costs, with heating costs. We might group that into a pool called facilities. You must also be familiar with the term cost driver. Now, a cost driver is anything that causes cost to change. For example, machine hours. The more machine hours, the activity, the more the costs if we're looking at setup costs. So there's a relationship between the activity and the cost. In the next section of this course, we look at inventory costing systems. Now there are two major types. Job order, which means we are producing a unique product. Each product is a job. And you contrast that with a process costing system, which is a mass production of one item. Think of a can of Coca-Cola. Next, we look at overhead application. Now, how do we apply these costs, direct material, direct labor, and overhead to the different products? Well, there's what's called the actual costing method. That means we trace the actual material, actual labor, and actual overhead. However, we don't know what the overhead is until maybe a month or two later. We don't know what the facility costs are, the heating or what have you. So this is not very practical, so don't spend much time on it. What is most relevant here is what's called normal costing. Normal costing means we track the actual material, the actual labor, but we come up with a predetermined overhead rate, and we multiply that by the actual activity. Then there is a standard costing rate. Here we set standards for material, labor, and overhead, and we set up a way now that we can budget and then provide variance analysis. Now, also in this course, I have lectures on job costing, process costing, activity-based costing, predetermined overhead, and all of these talks. So make sure you pay attention to those lectures and become very familiar with these concepts. We next move on to variable costing versus absorption costing. This is a very important concept and will likely be tested on the exam. That is, variable costing, when I only attach to the product the variable cost, direct material, direct labor, and the variable overhead. The fixed overhead is expensed as a period cost. Now, that is better for decision-making purposes. That is, the relevant information is there for the manager to make decisions, but it's not applicable for generally accepted accounting principles. It's not applicable for financial reports. Only absorption costing is allowed in the financial reports, which means that the product cost would have the actual labor, actual material, or actual variable overhead, and they would absorb a portion of the fixed overhead. So be aware, we will discuss this more deeply, the difference between variable costing and absorption costing, and the effect it has on net income. Be aware that management can manipulate the net income by using absorption costing. How they do that is that they produce more products than they sell. So each product absorbs a portion of the fixed overhead of that accounting period, but at the end of the accounting period, some of that fixed overhead is sitting in ending inventory. So that will distort your profit. In the next part of this course, we look at joint costing and byproduct costing. Now, we have a process in which the result of the process is that two products can be produced. That's called joint costing. One product probably high value, the other probably lower value. We also look at byproducts. Sometimes we have a process that's producing one product, but there is a byproduct like sawdust if we're talking a wood mill. Now on the exam, there may be a question about how we allocate these costs to the different products if we have a joint product process. Well, we can do it with the relative sales value. Now remember that. NRV. And we look at the net realizable value of each of the products, and we will allocate it such that the overhead is absorbed by the product that gets the most sales value. And another area you must be familiar with is how do we allocate these fixed overhead to the products with rates? Well, there's two types. You can use plant-wide rate, that is one single predetermined overhead rate. However, if we have many departments, that could be distortive. You can also have a departmental rate, that is one rate for each department. There are pros and cons for both of those. There is also a third way called the activity-based costing way. That is, we look at the activities and we assign the overhead in each department by the activities. This is more accurate, but is very complex. So again, the benefits and the limitations of each of these methods is what is important. Next, you should be familiar with some concepts in manufacturing, such as lean operations. Be familiar with the concept of just-in-time. That is, we produce or inventory arrives at the production table just as it's needed. There's the Kanban. Be familiar with that Japanese term. Also be familiar with MRP, material requisition production or required production. Also, outsourcing, the benefits and limitations of outsourcing. Next, be familiar with Dr. Eli Goldratt's theory of constraints. That is, we identify the bottlenecks in the manufacturing process and we maximize throughput by managing those bottlenecks. Be familiar also with drum buffer rope, which helps us manage these bottlenecks. We will also discuss the theory of constraints and its relationship with activity-based costing. We will look at the value chain and analyze the different stages in the value chain, and this introduces an important concept of value-added versus non-value-added activities. In the latter part of this course, we will talk about process re-engineering and Pareto's diagram, how we use the 80-20 rule. And finally, you need to have some knowledge on benchmarking, on Kaizen, which is continuous improvements, Japanese for continuous improvement, and activity-based management. So this is rather a very quick overview of the section on cost management. We go into each area in much more detail.